Welcome back to the podcast. This episode, we are joined by Mr. Jordan McNamee, founder and chief investment officer of the Optimist Fund, an investment fund with approximately $40 million under management. Prior to founding the Optimist Fund, Mr. McNamee worked at CI Global Asset Management as lead portfolio manager and Cambridge Global Asset Management as an analyst covering the global technology, media, and communication services sector. Mr. McNamee earned a Bachelor of Business Administration degree from Wilfrid Laurier University and has also earned the CFA designation. Among other things, we discuss finding undervalued growth companies, capitalizing on market volatility, and building an investment fund. This podcast episode is powered by ATB Capital Markets. ATB Capital Markets provides financial solutions and strategic advisory services to help businesses thrive. With a track record of successful deal execution, ATB is a full-service investment dealer with a deep understanding and commitment to the industries it serves. Visit atbcapitalmarkets.com for more information. This podcast episode is brought to you by EPAC, the Explorers and Producers Association of Canada. Good afternoon, Mr. Jordan McNamee. Thank you very much for doing this. I really appreciate your time.
Yeah, looking forward to it.
The listener, you are the founder and chief investment officer of the Optimist Fund. But what is the Optimist Fund?
We are a fund that focuses on investing in public companies that are run by very intelligent, proven, ambitious operators that have significant growth opportunity that we think is like materially undervalued. So a great example of a company we would own is like a Carvana or a DoorDash, always these businesses that are run by typically founders that have a lot of growth opportunity.
To maybe start at the beginning, how did you get into investing and why?
So I was really into sports as a kid, and I put 110% of my effort into football. And then when I was 18 years old, I got 2 concussions over the span of a weekend and had to take a year off school and recover from these concussions. And at this time, I don't know if you ever had a concussion, but at the time the protocol was like sit in a dark room. And so like within like 2.5 months of being in a dark room and being by myself, I was like, okay, I'm done with sports. I'm just going to I need to like pivot my focus to, something else now because I never want to deal with this again. And so then I was like figuring out, well, what do I want to do? What's something that's really competitive that also is financially rewarding? And that's how I came across investing. And I'm just like a very addictive person. When I get interested in something, I just like dive all in and become obsessed with it. And that was the case for investing. And then the bug got me, and I went to Laurier, interned at Gluskin Sheff, which is now owned by Onyx, but used to be a public company. Then I became an analyst at a group within CI called Cambridge Global Asset Management that managed about $20 billion. And then about 3 years ago, actually in 2 weeks exactly, I started Optimist Fund, which was the goal from the get-go, is to start my own strategy that's only focused on long-term compounding. Doesn't have all the same constraints that most mutual funds have. Really, it's just about maximizing long-term returns.
How would you describe your investment style?
I would say I would describe it as a growth-oriented value investor. So like Morningstar Box would always be like, oh, he's a growth guy because I own companies that aren't low price to book ratios or aren't very low PEs. Typically, sometimes they could be, but typically they're not. But like, I just think of value. I think, value is just present value, future cash flows. So whether the cash flows are coming today or you're reinvesting all the cash flows you could earn today into growing the business further in the future, all it matters is my view on the future cash flows and where the stock is trading relative to what I think is going to happen. And so I view myself as a value investor, but what I'm good at is identifying, higher growth companies that could have a really strong economic model, but are reinvesting all their capital back into the business. And so that's been like my forte of finding value, is in these higher growth, higher reinvestment companies. So that's a long-winded way of saying I'm a growth-oriented value investor. That's what I go by.
To lay the foundation of your investing style, was there anyone that you found influencing you? Maybe a classic Warren Buffett or Phil Fisher growth?
Warren Buffett, Bill Fisher, even like a lot of Michael Mauboussin's books, I found they were very formative into like understanding expectations. And that really drove a lot of my thinking around better predicting businesses and their future economics. And that's really what's going to drive big gaps in performance, is having a variant perception on future fundamental performance. But I would say like the bigger thing that drove my investment philosophy was just the fact that I started looking at software as a service companies, or even broader saying a subscription based business in like 2013. And I learned how you grow a subscription based business, which is marketing. You market to get customers, and then you retain those customers and earn cash flows from them. But you might market $100 for a customer that's going to pay you $30 a year for 10 years.
Mhm.
And so the first year you lose a lot of money. And so that really like formed my understanding of unit economics, and how some businesses' investment spend is pure operating expenses. And so it can really uncover, or it can really hide underlying earnings power, because all of this investment is front loaded in the income statement. By doing a bunch of work on several software as a service companies in 2013, it kind of flicked this switch in my brain. And then I met a bunch of portfolio managers at the time that were doing very well, and I was talking about this. I was talking about like how to look at SaaS companies and how their income statements are like underrepresenting their true underlying earnings power because of the reinvestment in acquiring more customers. And most of them were like, that doesn't make sense to me, or that's not interesting, or oh, I don't care because I just need a high ROE. And that really like made me realize, wow, there can be really huge gaps or huge money making opportunities, frankly, when something doesn't fit someone's mold. Like if you're like, I can only buy a company that's under 10 times earnings, and I'm telling you this business that's break even is cheap, it like breaks some people's brains. It's like, oh, I can't be cheap, but it can be, and there can be nuances as to why that is, and uncovering those nuances is really like it really intrigued me a lot.
In March of 2022, you started the Optimist Fund. What was your value prop to clients and investors who have options with their money?
The value prop is we are going to focus on maximizing 5-year returns by deeply researching a few high quality companies run by high quality managers that are significantly underappreciated. And while most of the market is focused on minimizing volatility or trying to avoid it at all costs, we are going to use that to our advantage, and just our North Star is going to be our 5-year returns. And being in the investment industry and working for a mutual fund company, there's just a lot of the industry is focused on just minimize, like it's, even though this could be a no-brainer buy opportunity, we got to wait. We don't pull the trigger because it could go down more over the next couple months. And if you look at any highly successful investor that has like a multi-decade track record, nearly all of them have more volatile strategies because they're concentrated and focused, and they actually, take advantage of high uncertainty situations. And so that's what we're doing at Optimist, and that's what we have done so far. And there's a good amount of people who are interested in that are long-term focused investors.
Sometimes people get scared when they see their stock go down by 20%. They want to pull their money out. Did you have to limit redemptions at the fund to make sure your clients don't get too worried?
No. Everyone who is invested in Optimist understands what we're trying to achieve. Our goal is to maximize 5-year investment returns, and it's a more volatile fund. Like I started the fund at the worst time possible. If you look from like a macro perspective, like March 1st, 2022, it was like a couple days after Russia invaded Ukraine. It was right as interest rates started hiking. And I'm focused on these ambitious growth oriented companies, right? Which was exactly the type of companies that got smacked in the face at this exact time. So I started the fund. My first year, I was down 50%. Didn't lose a single investor because everyone understood what we're going after, what we're doing. And then in 2023, we're up 83%. 2024, we're up 67%. And then so far this year, we're up, as of today, like 18%. So the fund's compounded as of today, roughly 20% annualized. But it's been obviously more volatile than most funds. But, we've delivered much higher returns than most because of actually just focusing on maximizing long-term returns and taking advantage of some of these big dislocations. But no, like my investor base is awesome. I have a fantastic group of investors that are all focused on getting a lot wealthier over 5 years.
It takes money to make money. To capitalize the fund, how did you approach that? Was it friends and family, or did you raise money publicly?
Yeah, so we started with a little over $6 million. So I partnered with Bloomberg Sen Investment Partners, which is a Toronto-based firm. And so of the 6 million, about 5 million was from Bloomberg Sen, and the remaining was from myself, from friends and family. So now we're just about 40 million and just about 3 years in. So it's that's been a mix from asset raising and performance. So I think we've in total raised just under about $20 million, and the appreciation is what gets it to 38 or wherever we're at right now.
And to create a symmetry of risk with your investors, did you feel it was important to put your own money in the fund?
Of course, it wouldn't make sense. I don't understand why you would not, like, if someone's starting a fund, their whole life should be levered to that fund. That doesn't even make sense why you'd have it any other way, in my opinion. But I guess maybe there's a counter argument.
Between the various layers of trading fees, management fees, capital gains, and taxes, it can be hard for active fund managers to outperform the indexes. How have you approached that, and how do you consistently provide value to the shareholders?
Research. That's, at the end of the day, the fund's value add is doing in-depth research, finding an edge on a handful of names, and constructing the portfolio in a way that's going to maximize our returns based on that research that we have. So, like a prime example would be just in 2022, when a lot of names became exceptionally cheap based on a narrative about their business that was incorrect. Like Carvana is the most notable, where Carvana, when we first bought it, was $128. A year earlier than when we first bought it, it was $360. Went to 128. I thought, oh, I've admired this company for many years, and this could be a very attractive point to start a position. Then, as 2022 progressed, stock went from $128 to $60. And I was like, this is very attractive. I think we're going to make a lot of money on this position. Then I went to $20, and then by the end of the year, it went to $3.50. And everyone thought it was just a complete finished conclusion that Carvana was going bankrupt, which I never understood how that would occur based on the economics of their model and the liquidity that they had at the time. But that was what everyone was convinced of. So anyways, in those scenarios, like, this is the type of research, this is why research is important, is in a situation like that, obviously, if you didn't really understand the company, likely you'd run to the hills, which people did, which was what made the stock go down like it did. But we knew the economics of the model were strong, that they could turn around the business, and that they had enough liquidity, enough time to do it. We kept buying, brought our average cost down to $30, and now it's a $290 stock, and it's an incredible company, and probably one of the great comeback stories in the last 10 years, I would think. But again, it just comes down to the research. Like 10 holdings is 80% of the fund. So I don't opine on like geopolitical theories, or I'm not the guy who has an opinion on everything. I'm not the guy who has an opinion on that many things, frankly. But I do have a very strong opinion on my holdings, and 10 of them is 80% of the fund. So I'm very focused on finding these asymmetric opportunities where I have a research edge, and then really pressing on that advantage to maximize returns.
This podcast episode is sponsored by Connate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Connate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@connatewater.com or check out connatewater.com for more details. This podcast episode is brought to you by JSG Professional Services, Canada's trusted leader in pipeline construction management and inspection resources. JSG provides competent, qualified, and verified pipeline construction management and inspection resources, supporting Canada's largest pipeline companies from initial development through final execution. Whether your project involves new pipeline construction, integrity programs, maintenance, pump stations, compressor stations, or inline inspections, JSG has consistently delivered experienced professionals to Canada's energy industry. JSG proudly supports Canada's energy infrastructure with competent, qualified, and verified pipeline construction management and inspection resources. Visit jsginc.com for more information. In your research process, do you run screeners, or how do you narrow down the names you're looking at?
So I do run screens that just gives me like a list of 1,600 companies, frankly. Like the fund focuses on global developed markets, so it's 23 countries around the world. And then I focus on companies that are bigger than 250 million market cap. Then I get a list of roughly 1,600 companies. And I also want to make sure the companies are growing, faster than nominal GDP over a 5-year basis. So I'm looking for companies that are growing, not shrinking. And that gets me to about 1,500 to 1,600 companies. Depends, obviously, on if I do it this month, it might be 1,600. To do next month, it might be 1,400. But it usually gives me that number. And then I flip through every company. And I've been doing this since about 7 years now. Since 2018, I've been running the same screening process that just makes it so that I'm always turning over a lot of rocks. But then, as you can imagine, I'm also finding ideas from different sources as well, like peers that are looking at ideas or competitors of different businesses that I come across from just living my daily life. Like, you're just always looking for different ideas that could be interesting. But I turn over a lot of rocks because at the end of the day, I'm just looking for like that, I want to find a very high quality CEO. So that has to be that's number one. If the CEO just started yesterday, I don't care about it for the most part. So that's a lot of my screening is just like saying what I don't care about versus like what I do like. And so then if you meet a CEO has had a lot of success or has a very different opinion or view of something that's very like out of favor or non-consensus, like that can be very notable or interesting. And then you follow them for several years and you track how that's been progressing and how the business is progressing, and really gets down to like a list of I have about 50 to 100 companies that I actually follow closely now. And then I own 18 companies right now. And like I said, 10 are 80% of the fund. So it's always trying to whittle down to that list of companies that I think are ambitious companies run by smart people that have a lot of growth opportunity that, most importantly, is underappreciated. If it's not underappreciated, I don't care about it. Like, at the end of the day, I have to have some sort of angle or edge that is different than what everyone else sees for us to generate outsized returns.
Yeah. The trick is identifying a company that's undervalued that other people don't know. A lot of times the value is baked into the price, especially with high quality companies. So
100%.
Is there anything you look for, like a distressed situation, or does it just vary? How do you think about that? Has there been a good example of maybe the Carvana example?
The Carvana example is definitely a good one. Uber is a great example too, where people were very skeptical of Uber's unit economics in aggregate because the aggregate company was losing money. But then if you looked at like Uber in different regions, you'd see, Uber in this region is actually highly profitable. It's a great business, but it's like not good in this region. And this was kind of what I was talking about before on like understanding unit economics has been a common way for us to find alpha, has been where people look at a business and in aggregate, it might have low margins or negative margins. And so then people have this perception that it's like not a good business. And then when you really peel back the onion, you can recognize, they actually have a really high margin business in here, but they're investing in this part of the business that's dampening the overall economics of the company. And so what's our view on whether or not the economics on their investment portion are going to revert to the rest of the business, or is the good part of the business going to revert to the bad part of the business? And so that really, like, again, it comes back to research, like understanding the customer economics, understanding where expectations are, how people are perceiving something, and then what in reality is going on. That's where we find it. So you can only find that through going through a lot of names. Like you gotta do the work to dig in. You can't just kind of like run a screen and be like, oh yeah, these are all the companies that are underappreciated. Just doesn't, at least for me, it hasn't worked that way. It's always been through putting the work in.
Sometimes you can get caught in a value trap where you think there's value, but the value never materializes. On the other hand, it's easy to overpay at times. So how do you think about both of those two extremes?
So I rarely am the person who gets caught in a value trap because the businesses I own generally aren't viewed as value. So typically a value trap is going to be a business that's like cheap from a quantitative, like from that quantitative measure of price to earnings or something. Someone says, oh, it's a 15% free cash flow yield. This is an amazing cheap business.
Mhm.
And then you're kind of saying that for 5 years and it doesn't grow and nothing changes. So that's not the type of companies that I focus on. Now on the overestimating portion, that is an area that would impact me. That would be more in the two examples you give, that's more where my mistakes will be made, is on, thinking a business is going to grow 30% a year and then it grows 15% a year. And so your view on value was incorrect. And so in that perspective, it just comes back to research and margin of safety as well. It's like, if I think a business is going to grow 30% a year, and if that happens, we double our money over the next 3 to 5 years, then okay, that's the upside case. If I'm wrong and we compound and the business compounds at 15%, are we going to lose 10% over 3 to 5 years? Then you have your kind of risk reward framework, right?
Mhm.
And so that's how I always think about things. Is that I generally am not looking at something where I think the downside case is going to be more than a 30% loss over 5 years. And so if I have like a collection of 20 companies where the upside is we 2 to 3x over 3 to 5 years, and the downside is we lose 20%, you have a 50% plus hit rate, your aggregate returns get very attractive. And so that's how I think about it. And that's how it would, that's the environment, that's the lane that I would swim in. That type of issue of like having too high of growth rates in the future.
When you're doing due diligence, are you literally printing annual reports out and reading all day long? Do you take a qualitative approach to valuation? How do you think about that?
I do not take a qualitative approach to valuation. I DCF every company and have a forecast for what I think the results are going to be over the next 10 years. And so everything's quantitative. I actually don't think when someone says, oh, what are the qualitative factors and then what are the quantitative factors? I don't think there's a difference. I think they're one. There's no qualitative factor that doesn't translate itself to quantitative and vice versa. They're very interlinked. And so everything at the end of the day should be reflected in a model, in a financial projection. If it doesn't have an impact on the model, then you shouldn't even be talking about it. It's irrelevant. And so, yeah, I'm incredibly quantitative.
Some people would lean towards a 0 to 1 sort of business model like Peter Thiel, where you have to solve a problem that's never been done before. But on the other hand, some companies are value prop is the brand or the intangible kind of mode, if you will. Do you think about
Yeah.
that? How do you think about those two extremes?
In terms of what that the moat is not quantifiable because it's a brand, or
Yeah, some people would say you need to please your customers, and the brand is the most important thing. It's intangible, like a C's Candies. Others
yeah,
like say you need to solve a problem like a SpaceX, where it's very 0 to 1. How do you think
yeah.
that when you're picking businesses?
I don't really have like a I'm only looking for one or the other. Yeah, I don't have like a religious view of like I'm only looking for the low cost provider or I'm only looking for the person that like solves a distinct problem.
Mhm.
I'm just looking for businesses that evidently are creating value for their customers and so are willing to charge an amount that makes the business highly economic.
Mhm.
That's at the end of the day, that is my framework for thinking about a business is just the model has to be economic enough that it works for the shareholder, the employee, and the customer. That's my North Star.
The market's been going up the last 5 years, more or less. It's been a great time to be just an index investor. But from your perspective, how do you protect value for your clients when the markets inevitably go down? How do you think about that, capital protection?
So I think of capital protection as protecting capital over a long period of time. I don't think about it as, oh, the next 3 months. Like when people say capital protection against a market drop, that's just not language I use. Like I just would compare it to, like, let's say you owned Tim Hortons and the market goes down. Would you go to the Tim Hortons owner and say, hey, have you protected capital in the last 3 months? Your Tim Hortons franchise is worth less. Like, it would be a ridiculous thing to say. I understand some people think that way, and I'm not saying they shouldn't. I'm just saying I don't, and that's not how we manage the fund. So I think of capital protection as, what are the downside cases on the businesses that we own? And in those downside cases, what type of value would make sense for these companies over the next 5 years? That's how I think about the downside. But, like, as you know, like when you have market events where all of a sudden people are just selling, like there's not like the stocks are going down in that period, not because of fundamentals. It's just, they're just selling. If it's a good business, the value will surface over time. It will. And if it doesn't, they'll buy back stock and it'll accrue to the shareholder anyways. And so I think I focus really on the capital protection element from the fundamental business and being right on the investment thesis. And if we're wrong, what does it look like? Versus there's an economic shock and the stock market went down because of like a flash crash or something like that.
The psychology of the investor may be one reason markets sell off a lot of the time. How important do you think the behavioral side of investing is, where you can really take advantage of the increased selling at times when investors are scared?
It's incredibly important. It's as important as everything else, I would say. A lot of people say they're a value investor. Let's see their stock go down 70% and see if they still say they're a value investor, or if they all of a sudden are like, oh, if nothing changed, you should be buying more. And so, yeah, I would say behavioral is everything. It's critical. But it ties into, like, if the research isn't there, like if the research is there and you have bad behavioral controls, then you're going to make mistakes, clearly. But if the research isn't there, a lot of the behavioral will just be driven by not having the research. Because if you don't have true conviction in something and all of a sudden everything's down 50%, you're not going to stick around for the most part. You have to know the names well to stick through volatile periods, in my opinion.
And having cash when the stock goes down, do you structure the funds so you have some dry powder to take advantages of psychology?
Sometimes I do, but to be honest, I actually don't think that you need to always have cash. You need to have a portfolio that's not fully correlated, so that if things sell off and one thing's down 25%, something else can be down 5%. And so you can reorient some of your portfolio to some of the more dislocated names without having to necessarily be sitting in cash. I'm not someone who's going to, like, have 25% of the fund in cash for 5 years waiting for a doomsday. Like, I don't think that's not what I'm going to do. So I've taken it more from, like, a relative approach, where in scenarios where some names are more dislocated than others, then rejig the portfolio to reflect that.
This podcast episode is powered by Broadbill Energy, the local midstream company that puts producers first. Broadbill Energy does things differently and doesn't just move energy. They are moving the industry forward. While others take a cut, Broadbill shares profits back with their customers, because when Broadbill customers win, so does Broadbill. With a producer-focused approach, Broadbill specializes in the gathering, processing, and transportation of oil and gas, ensuring safety, reliability, and maximum value for the people who actually produce the energy. If you're tired of the same old midstream model and want a partner that works for you, it's time to talk to Broadbill. Visit broadbillenergy.com to learn more. This episode is brought to you by Astro Oilfield Rentals. Planning your next drilling or completion site, or budgeting for an upcoming construction project? Astro has your remote communications and accommodations needs covered. With over 25 years of experience serving Western Canada, Astro continues to expand, innovate, and deliver the best value for your investment. Astro offers a full range of communication solutions, including cell towers, radios, and internet services. Astro's lineup features well site trailers, sleepers, full gym units, medic centers, and custom-built command centers, helping you stay connected and comfortable in even the most remote locations. Visit astrorentals.ca for virtual tours and more information. Some investors would view it as raising capital for the rainy day, but it sounds like you kind of are invested for the long term regardless.
Yeah, well, it's effectively saying if I had no good ideas, then sure, that would make sense. But if I found a bunch of idiosyncratic ideas, I'm not going to then say, oh, I want to have a lot in cash because of the broad view that the market's expensive. So it's always going to be micro for me. It's always about the individual idea, the individual investment opportunity. That's what drives like the cash weight.
The management fees of the fund, if I'm correct, it's a 1% flat management fee with a 20% in excess of 6% hurdle rate. How come you structured the fund management fees that way?
So that the fund is focused on delivering exceptional performance. That's the core driver. That's what I'm incentivized to do, and that's what I wake up every day thinking about is putting up very strong numbers. I do not plan on being a fund that is just trying to become very, very large and then collect a management fee. It's obviously a common thing that happens, but that's not me. That's not what we do. We focus on putting up very exceptional numbers. That's always going to be the focus. That's what I love to do.
What is too big? When do you think funds get too big? Is it hard to quantify, or would you have a number that you might
For
close up?
me, 2 billion US is the cap of the strategy.
Hmm.
My average market cap right now is 24 billion US. So I could do everything the exact same at 2 billion US is the cap. But for every strategy is different. Some that would be nothing. Like some people could, do the exact same thing at 30 billion. Others, they cap out at 75 million. So it all depends on the strategy. But for mine, it's 2 billion US.
When you're valuing companies, some would suggest EBITDA is a bullshit valuation metric. Others would say it's a good proxy to cash flows. How do you think about that subject when you're looking at companies?
It depends. It's like EBITDA, it's kind of like saying, like if someone says something's 10 times EBITDA, and then someone says, oh, that's BS. But if that translates to 14 times earnings, then what are you going to be like? Is it BS? You're just measuring something before a few expenses that add on to get to your net income. So I think it's a bit of it's like Charlie Munger said bullshit earnings, and then people like that saying. It's like a nice statement, but I sure for some businesses, valuing it on EBITDA might make no sense because the duh is enormous.
Somebody has to pay interest and taxes.
Yeah. There's not that, just like depreciation and amortization. If you're an incredibly capital intensive business, like with huge maintenance capex, then yeah, the duh is like really important. But then I don't know, someone might adjust for that and they'll be like, oh, this business should trade at 3 times EBITDA. And so that sounds really cheap in your head, but like it might not be because the duh is massive. So this company that's 10 times EBITDA and this company's 3 times EBITDA, they're actually like both the same on EBIT because one has much higher depreciation rate, right? So yeah, I think it depends. Like at the end of the day, present value future cash flows is the only thing that matters. It's all you get. It's the only thing the company does. Present value future cash flows. So some people look at all these different metrics and they at the end of the day they're usually just like a shorthand. It's like, I look at a company and it could be 5 times sales and someone could say, oh, you're valuing it on sales, and it's like, well, the business should do 30% free cash flow margins, and so 5 times sales at 30% free cash flow margins, that should imply roughly 15 times free cash flow. So someone who's investing in software might be like, oh, okay, my default thought in my head is like 5 to 6 times sales is like 15 to 20 times free cash flow on a normalized basis. And so it's not like anyone who's like just saying, oh, let's pay 5 or 6 times sales is like, doesn't think that they should generate something in the future. It's just become a shorthand for like the underlying business. You know what I mean? It's like when someone says 7 times EBITDA. If 7 times EBITDA resulted in no earnings, then it wouldn't be 7 times EBITDA. But 7 times EBITDA becomes this like norm because it then translates for some businesses to like 15 times earnings. And so you could say, oh, it's 15 times earnings, or you could say it's 7 times EBITDA. But they could both be the exact same thing, but you're just looking at different things.
Coming through the CFA program and various textbooks, the traditional definition of risk via volatility is the up and down movement of the stock. How long did it take you to realize that was in fact an opportunity rather than risk?
Not long, because I was obsessed with microcap companies when I was in university. So that was when I really first got into investing. I was obsessed with looking at microcap companies. And so you look at a microcap and you realize that volatility is pretty normal. In my mind, volatility is not risk. It's just reflective of the uncertainty that market participants have about the future of the company, which could then mean the more volatile it means, the more opportunity for alpha generation through deep research.
I was reading that a good chunk, 60% of the fund is invested in consumer brands. Do you have a preferred sector?
Consumer, technology, and industrials would be the core sectors that I spend the most time on. And right now I see the most opportunity in consumer, but I'm really a generalist. Like I'll go anywhere, but those are where I find the most opportunities. I own a lot of consumer internet companies that got decimated in 2022. And so that's why I'm so shifted towards that area right now, because it became a graveyard in 2022. And I think a lot of them are great businesses that are going to emerge from the ashes.
Well, the Optimist Fund is doing well nowadays, but looking ahead to the future, what is the plan for the fund? Just to keep growing slowly?
Yeah, just keep putting up great numbers for our investors. And we hit our 3-year track record mark in 2 weeks. And so, just keep growing. Keep grow to, like I said, we could do the same thing up to $2 billion US. So just keep doing what I'm doing now until we get there. And then even then, it'll still be the same, just picking stocks and delivering for our investors. I still see so many opportunities in a lot of smaller companies. That excites me a lot. So I think there's a lot of opportunity over the next couple of years.
Awesome. Well, we can end the formal conversation there. Thank you very much.
Great.
Hello, listeners out there. Thanks for checking out the podcast. Hopefully the episode provided some insights. If you enjoyed the show, check out trose.ca where more episodes are yet to come. You can also subscribe to the podcast where your token of support is much appreciated. Until next time, happy coffee drinking.